Hello and welcome to this week's edition of Hidden Wealth TV, the show committed to helping you discover and uncover your hidden wealth. I'm your host, Kristen Oakley, and joining me in the studio, we have Chuck Oliver. He is the founder and wealth strategist at Hidden Wealth Solutions. Chuck, it's great to see you in the studio again. How are you this week?
I'm doing well, Kristen. How are you?
Good, thank you. I know you've put together a jam-packed show for all of you at home today. The title of today's show is Taxes and Inflation Equals Retirement Annihilation. The bottom line is we have to be prepared for taxes in retirement. This is such a critical conversation. Chuck is going to be sharing with us a lot of the issues that are going on in Washington right now, things you need to be aware of as it relates to your retirement, as well as some solutions and some real-world case studies of how you've been able to help people navigate these tax risks. So I'm excited to have this conversation with you today.
Very excited. This is the most popular question we get.
Oh, for sure.
Yeah.
Well, when it comes to retirement tax risks, what are the most important ones folks need to be aware of? What do people need to be concerned about?
Well, the tax in itself, right? The tax that they're going to face. A lot of people are not familiar. They don't really know as we like to say, the tax risk road they're facing. They definitely are not aware of the legislative changes that are being proposed in Washington as we talk about Washington's war on wealth. And having actual real-life solutions, things that they can actually do to take advantage of the tax code as opposed to the code in Washington or the government taking advantage of them.
Because I love this saying, you talk about there being two tax codes, so explain what you mean by that.
Yeah, it was a former appeals court judge. His name was Judge Hand, and he said, there's two tax systems in this country, one for the informed and one for the uninformed. But you have a choice, and a lot of people unfortunately don't feel that they have a choice because the conversation is not typically one of which, as we like to say, kind of the big box store brokerages will address, because it's not just focused on that whole accumulation phase. So the tax piece is just, it's really, there's a real void as it relates to that subject.
And what is the danger of not paying attention to this tax risk?
I mean, we're talking 6, 7 figures depending on what the client, the couple or the individual's personally already saved. And the earlier you get started, the more tax you can actually save.
Right. Yeah, so it's never too early to get started, is what you're saying.
That's what we love to say. It's never too early, it's never too late to get a head start, to be sure you're being tax smart, because the tax piece, we say don't let the tax, tail wag the dog. A lot of people don't understand that you have to address the taxes. If we don't get the taxes addressed, everything else is going to be inferior, because there's a tornado, as we like to say, of other taxes that get triggered by what people have saved typically in their 401ks and IRAs.
Right, and I think it's interesting, you use the word annihilation for today's episode. That's a pretty strong word, so define that for us, what you mean.
Well, it's actually defined as destroy, right? So annihilation means to destroy. And what we typically find, especially if, let's say, somebody out there is listening and they're saying, I don't know that this is being addressed, right? This is not a conversation that typically comes up for me. The challenge are going to be the other taxes that fall into play, right? Taxes to their Social Security, indirectly taxing their Medicare. And so not realizing what these required minimum distributions, since, as we like to say, 95% of our clients have saved 95% of their wealth in these tax-deferred, what I call ticking tax time bombs. Delaying that decision, the time is not now to be sitting on the sidelines, because the longer you wait, the more tax you're going to pay.
Well, and to your point, there's the informed and there's the uninformed. And I would argue that the government a lot of times doesn't want folks to be informed because they need the money, right? They're wanting the tax. Talk about that.
Well, they have no problem spending. This administration in particular is spending, as we like to say, like a drunken sailor. And there's no spending end in sight, right? The new budget that was proposed by the Biden administration is now quickly approaching $8 trillion. But inside of that bill, that budget, whatever we want to call it, it's a bill, it's a tax bill, are over $4 trillion of new taxes. And so it's really making sure people are educated about, what's coming, how do you untax your income, how do you untax your assets, and then how do you keep your money untaxed going forward?
Right. And I think the reason why this is so problematic for so many folks is that the majority of Americans have the bulk of their wealth saved up in tax-deferred accounts. Things like 401ks, 403bs, traditional IRAs. And Chuck, what's so disheartening about that is when these plans were developed, we were told that this was a really good thing for us because you put the money in today, you get a tax break today, then supposedly in retirement when you go to take the money out, we were all supposed to be in a lower tax bracket.
Yes.
But is that really happening?
Well, no, that's not happening at all. And in fact, when the 401k/IRA were invented, right, the top tax rate was around 70%. So you would think, surely to goodness, that if you put away money pre-tax, that when you retired, you wouldn't find yourself in a 70% top tax rate. The problem is that the script has been flipped. And so now tax rates are actually on sale. In fact, we have a tax sale, which I'm sure we'll talk about, that people could take advantage of before we know taxes are going to go up, before just taxes in general are going to have to go up to obviously account for all the spending. So the idea that you're going to retire at a lower tax rate is unfortunately a situation where somebody is likely going to retire not very well off. Because people that have accumulated and tax deferred again and again and again, it's just building the snowball effect of then having a higher distribution. And of course, inflation has really hurt this too, which is another form of taxation I'm sure we'll talk about. But it's kind of what I call the big government tax trap, is this sense that we're going to retire in this lower tax rate, when the reality is, even in some of the case studies we'll talk about on the program, people can trigger what tax rate they think they're going to be in. And if you just look at what their requirement of distribution is going to be, it's already going to put them in a higher tax rate than what they're projecting. So this tells us the naivety. And in fairness, because it's not a typical discussion, that the consumer is not really realizing what they're about to face.
Right. And I think it's important to be clear that we're not talking about tax evasion here. We're talking about utilizing the strategies that are perfectly legal within the tax code to help folks pay the least amount to the IRS that you are legally required to pay. And when folks don't know that they have some of these options available to them and they're unknowingly paying the tax, they could be paying way more than what they're legally required to. And the government's not going to say, oh, by the way, you paid us too much, right?
Yeah, you overpaid us, so you should check this box or check that box. No, they're not going to do that. And that's why probably the number one thing we get is a client will say, Chuck, as I've heard you on your radio programs, I've seen you on the TV programs, we're not retirement tax ready. And that's why we like to ask people, are you retirement tax ready? Because if people are being honest with themselves, they may think they're tax ready, they're not tax ready.
Right. Well, I know I'm excited to get into more of the solutions, and we're going to be going through some real-world case studies of folks that Chuck and the team at Hidden Wealth Solutions have been able to help folks enact to be able to lower their tax burden in retirement. But if someone's watching right now and they just answered that question and they're like, I don't think so, I don't know if I'm retirement tax ready, what would you say to that person?
I would say, and I'd emphasize the importance of having an actual complete retirement plan that actually addresses taxes, right? The idea that, taxes are kind of an afterthought should be your first thought. We always like to say, Kristen, if you don't get the taxes right, everything else is going to be inferior. So this is not the time to sit on the sideline, right? We have a tax sale. We have obviously a spending administration who's spending like no other. The spending is not going to go down. The new budget that's being proposed is approaching $8 trillion. We have some top economists will say it'll actually reach $10 trillion over the next decade. And this is just going to force taxes to go higher anyway. So taking advantage of addressing the taxes as part of a true comprehensive, what we call personal wealth blueprint, is just vitally important.
So if someone calls in today, you offer this complimentary, personal wealth blueprint.
Right.
Talk through exactly what they're going to get.
So one of the first things we address in sharing with them is, what tax risk road are they on, right? That's kind of a sobering reality to see, wow, I didn't realize to the magnitude of not just what the taxes are going to cost me, but what's that going to end up going on to cost my family, especially if people are looking to pass money on to heirs. And then we show, how do you build that into an actual comprehensive plan to where it's a true blueprint, like a roadmap. It's a blueprint to lay out, not just having tax savings, but what's the tax diversification of what they're doing? Where should they be pulling income from first? What should they be Roth converting? And candidly, a lot of it's all cause and effect. So the way you set up the timing of your Social Security, or we like to call it the retirement red zone, people that haven't filed for Social Security, this is a crucial time for them, because we get that probably as a second question. Not only how do I save taxes, but how do I best plan around the Social Security?
Right.
The two have a huge impact on one another. So being able to see how all that cohesively fits together to show you the road you're on versus the road you could be on is staggering in difference.
Absolutely. Well, we say this on the show all the time, that how you make a decision in one area of your financial life can and will affect all the others. This is why you can't afford not to look at things from a comprehensive, holistic perspective, as Chuck's talking about how your taxes can implicate with the rest of your financial plan. It affects your Social Security claiming strategy. So much goes into this. So if you would like help and receive your complimentary personal wealth blueprint from Chuck and the team at Hidden Wealth Solution, all you need to do is call that number on the bottom of your screen, 844-837-3652. If you'd rather not talk to someone right now, but you do have your smartphone handy, you can simply pull it out, and if you open up that camera app, you can point, click, and scan that QR code down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team will reach out to connect with you to schedule your complimentary visit that way as well. More on today's show. Don't go anywhere. When we come back, Chuck's going to be diving deeply in some real-world case studies and showing you how you could potentially save thousands of dollars of taxes in retirement. Stay with us.
I was kind of a product of the tech boom and bust at the turn of the millennium. You know, at the time I was not a financial professional. I already had one child. Our first son had been born and our second son was just born. My banker Larry said, why don't you just move maybe X amount over to bonds? At that time, bonds were actually not paying that bad. They were paying like 6 or 7%. Like, nah, Larry, I'm just gonna kind of stay and keep doing what I'm doing. And then of course, you know, things changed, things shifted very quickly. And so as a result of that, I got very passionate about really just becoming what I really wanted to be, right? Almost like the Gandhi quote, you must become the change you want to see. And so I went on a quest to study from the Tony Robbins of the world, understanding the Rich Carlton philosophy, self-educated, right? I went out and bought all the alternative products and the common products and tested them and compared them. And so as I kind of made that transition, it was unique because everybody else kind of went to the big box store brokerages, as I call them. And I just chose to remain independent because I kind of felt that there was this void that just wasn't being filled. It was kind of more of a transactional experience for the consumer. It was not a relational experience. And so that's where we kind of coined the mantra, deeper with few than shallow with many. And so it wasn't about gathering the masses. It was about really creating a real unique experience and a quality experience for the client. You have a choice in life, right? You can either be really bitter about a situation or choose to get better in it.
Welcome back to Hidden Wealth TV. I'm your host, Kristen Oakley, here with Chuck Oliver, founder and wealth strategist at Hidden Wealth Solution. We are diving deeply into the conversation of tax risk in retirement today. And Chuck, I know you are very passionate, the entire team of Hidden Wealth Solution, in helping folks pay the least amount to the IRS that they are legally required to pay. And to your point, as you shared in the first segment, a lot of folks aren't even aware that they have the ability to lower their tax burden in retirement. So I know you have some real-world case studies of folks you've actually been able to help do just that. So I'm excited to walk through these with you.
Yeah, I'm excited too, and especially the different age groups, because we have a lot of clients that will refer their adult children, and then a lot of the adult children will refer their parents. It's kind of fascinating how we're seeing that, like, hey, wow, we heard your program, or we watched your program, and my father really needs this, or hey, my daughter's a high income earner and really needs to learn how to cut her taxes. So we're seeing it across all age demographics in particular now.
That's awesome. So I know there's 3 case studies we're going to walk through, and the first one is for someone in their mid-40s. So can you set that up for us?
Yeah, so what we found, especially with some of our clients, very concerned about their estate planning and protection and what kind of inherited IRAs they may pass on to their children. They're saying, well, look, we'd rather you educate our adult children now so they don't kind of end up in our similar circumstance. And so we're starting to see more and more, and I say younger, but younger folks reaching out saying, you know what, I want to address this. Maybe they've even seen tax circumstances, you know, that are really hurting and penalizing even their parents, right? Maybe their parents are in their 70s and have their required minimum distributions, and they either see the writing on the wall or see kind of the misery that their parents are experiencing, and they want to avoid it themselves. So that we like to kind of start with the younger to get a little older and a little older in the examples that we want to go through.
For sure. So walk us through this first case study that we're going to share with our viewers.
Let's do it. So the first case study is Joe. And so we kind of named him, you know, Joe, Jim, and Max. But Joe's in his mid-40s, and he's done pretty well at saving. And so not everyone's going to necessarily have saved by mid-40s $250,000, but saved $250,000 in a tax-deferred type of an account like 401k, IRA. And the assumed tax liability, which is assumed, and I will put the emphasis on assumed, is 25%, because people sometimes look at that and think, okay, well, that may be the tax rate I'm in today, but let's talk about and try to plan for what the tax rate may be for you tomorrow.
Right.
And so the assumed growth rate, so we try to do this very conservatively, defaults to 5%. So we're not showing some outlandish growth rate, and we're not showing some super conservative growth rate. So somewhat of a semi-conservative growth rate of 5%.
Okay, so this is how much they have in a qualified account, which I always like to, I remind myself by saying a qualified account means it's qualified to pay tax on it, those tax deferred accounts.
Yeah.
So that's his situation today. Let's look at this next slide and walk us through that.
Let's do, yeah, because qualified to whom? Qualified to the government. So let's look at the next slide.
Okay.
So if you keep the qualified account, right, versus reallocate the tax-free, and everyone's eyes go to the reallocate to tax-free because obviously tax-free grabs people. So it's saying on $250,000, you could just pay the piper today and cough up about $62,500 and be done knowing where taxes are today. We are not proposing that. We're just wanting to show the comparison, the contrast to the left side being the if you stayed the road of the qualified account. Not only will your required minimum distribution taxes, right, be $247,000. That's at today's tax rates, as a friendly reminder to the audience. But then the taxes paid on the reinvested, what we call RMDs. So if somebody's not familiar with RMD, required minimum distribution, this is when the government starts forcing you out of the kind of the tax holiday that you've had to them. And then what you're going to pass on potentially to the next generation, to your own children, right, would be then another $238,000. So all told, it's about $560,000, which is
in tax that you're going to pay.
This is the tax that you're going to pay. As we like to say, likely at the best case, this is as good as it's going to get.
Right.
So, you're staring at almost what I think will end up being about $600,000 on what was $250,000 today. Somebody in their mid-40s is going to give up 2-3 times that just in unnecessary taxes.
Wow, it's mind-blowing when you can actually see the numbers side by side like that, for sure.
for
Okay,
sure.
So that was someone in their mid-40s. Let's go on to the next case
Yeah,
study.
let's go, because this is where we start to get a lot more traffic, right? This is where we have a lot of clients reaching out that are saying, wow, you know what, I'm coming up on trying to be within that retirement red zone, that 10 years or less of retirement. And so here we have Jim, age 55. Jim's done a pretty good job. He saved about $500,000. And again, for the audience and the viewers, whether you have $500,000, you have $200,000, you have $5 million, you get the point. And the assumed tax liability here was bumped up to 30%, same assumed growth rate. And if we go ahead and look, right, let's go ahead and transition to the second slide. Then in this particular case, Jim could take the road on the right and say, you know what, I'm just going to go ahead and pay the taxes, right? Knowing what the tax rates are today, which again is not being encouraged, it's just giving the example, comparing to the left side of keeping, right, this ticking tax time bomb that's going to throw off, right, $364,000 of just assumed to be at today's tax rates, taxes on once he starts withdrawing, he and his wife start withdrawing out of their IRAs. And then when they reinvest that money, it's what we call the double-edged sword, right? The government gets to now tax it a second time. And then that's almost $100,000, and then turn around and tax a third time, right, on the next generation, which is another $350,000. So all told, that's about $800,000. So
Wow. Yeah.
considerably more tax than what he's already saved.
Right. All right, so that's someone in their mid-50s, not yet in retirement. Let's move up the age bracket now to the mid-60s.
Yeah, let's look at what I like to call max tax, right? So the max case study is somebody in their mid-60s, right? And they've done, they've followed the crowd, right? They just stayed the course and said, I'm going to tax defer this out and tax defer this out, and they weren't, learning to mitigate and insulate their income and assets from Uncle Sam. So here's $1 million saved in that account. I think 30% is being actually generous because max actually comes from a state that has both federal and state income tax. And let's look at the results, because and Max was kind of blown away because he's looking at this saying, okay, I could cough up $300,000 today. Once again, there is such a more tax efficient way to do that.
Right, we're not recommending that that's what happens.
Totally not that, right?
Right.
Versus what is almost $1 million of total tax between the required minimum distribution taxes, the taxing of a second time when the money's reinvested, and then a third time on their children, and they have 3 sons. That's $990,000. And I think, Kristen, that is a gift if it ends up only being $990,000. But basically a 1-to-1 scenario. So as I've said this and I've written about in my books, whatever you've saved, typically for those that are really right in that sweet spot of retirement, will be the tax or more that you will pay based on just what you've saved in your balance today.
And that can be so disheartening for folks. And so we don't want to leave you on that note, because the good news is you have solutions of how to help folks reallocate to that second column. Of course, you've said several times you would do it a different way versus paying all that at once. So talk about the strategy you're able to employ for folks to do just that. Lots
of strategies. So in particular, it varies. It's going to be between business owners. So we help a lot of folks that have a business. So if you business owners listening out there, there's a multitude of strategies in particular business owners can accomplish. And those that aren't business owners, right? Maybe you were just a strong W-2 high wage earner. Many strategies that can be accomplished there as well. One of those strategies is actually teaching non-business owners the importance of actually, in a very simple way, to implement a business in or about to go into retirement, to pick up those other tax saving strategies. And what's really nice about it, Kristen, I know we've talked about in the past, we actually have a strategic tax team, right? So we have what's now quickly approaching almost 600 CPA firms with 600 top-notch strategic tax saving CPAs that, especially with artificial intelligence and with software advancement, we can actually take that client's tax profile, right? So we take their last year's filed tax return. We just did this for a client of ours out of Texas, husband and wife, and they were able to find just shy of $40,000 of tax savings based on what they could have done the prior year. So now we have the ability to look at the tax situation in today's terms and strategize. And a lot of people don't have that, right? It's very reactive. They have more of a tax planner, or preparer, excuse me, not a planner. And this is key. So there's strategies like utilizing and maximizing deductions from the standpoint of real estate, business equipment, energy, a lot of different strategic rollouts. There's a lot of different strategies, and kind of like DNA, no two people have the same, right? So it's going to vary, age, asset level, aspirations, things that they're trying to do. But typically there's 2, 3, sometimes more strategies that somebody can implement. And as I've tried to tell people over the years, it's not one particular strategy that's going to make or break the plan. It's a series of different strategies that cohesively fit best together in a particular order that really optimize the tax savings.
Right. So if someone's out there watching today and they're going, I need help, I need to figure out how to reallocate my assets to that tax-free bucket. I know we need still to talk about Roth conversions, which we will after the commercial break, but for someone to be able to call in today and receive that personal wealth blueprint, again, this is for no cost, no charge, no obligation. Talk about how that's going to help them.
So, for those of you viewing, what's going to help is you actually having not just an accumulation plan, but a transition to a true holistic retirement plan, right? Kind of moving to that distribution preservation phase. And Kristen, what ends up happening is by having, as they say, right, the sum is greater than all the parts, most people have not really had all the parts shown together, right? Seeing how those are going to line up one by one and be able to see the cause and effect before it happens so they can best strategize of what they should put in that particular order to prevent it and then keep taxes out of the equation. So it's a conversation. It's validating data, right? And then it's basically being able to show someone, here's the tax risk road and retirement risk road you're on in comparison to the road that you can be on.
I know you've been able to help thousands of people in this area, and you're excited to connect with more folks. So if you would like to receive your complimentary personal wealth blueprint, again, this is for no cost, no charge, no obligation. It's simply an invitation to have a conversation to see how Chuck and the team of Hidden Wealth Solution can help and serve you. All you need to do is call that number on the bottom of your screen, 844-837-3652. Or again, you're also welcome to take out your smartphone and scan that QR code, and that will get you connected as well. More on Hidden Wealth TV right after this.
So people today feel more confused than ever before, right? When you feel confused, right, you feel isolated. You feel kind of like you're on your own little island. You just don't really know what to do. So then that gives you that feeling of feeling powerless. And then people just become kind of overanalysis paralysis. They'll just sit back, and the best decision for them is just to not make a decision. And so then they're kind of stuck. And so what are they looking for? They're looking for direction. So my passion is when we can have a client, which hence the name Hidden Wealth, and help them discover and uncover like all these things where we've gone before them, self-educated, tested, some worked, some didn't, etc. But then we found the formula of like the proper strategies, and then in the most strategic order, people then have that direction. It gives them a huge amount of confidence. Once they have that direction, right, and now the confidence, they have this capability that they didn't even realize that was even possible. So direction creates confidence, and confidence creates capability.
Welcome back to Hidden Wealth TV. I'm Kristen Oakley here with Chuck Oliver from Hidden Wealth Solution. We've been talking a lot today about how to lower your tax burden in retirement. My goodness, Chuck, I know we've hopefully not scared folks when they think about how much they're potentially going to pay in taxes in retirement, but it's a serious wake-up call for a lot of folks. A lot of people aren't aware of this tax risk road that they're traveling, which I know you say a lot. One of the things we wanted to talk about too is Roth conversions. You know, you showed those case studies. You talked about how folks can reallocate their wealth from these tax-deferred accounts to tax-free accounts.
Right.
Talk about how that strategy actually works and what your recommendation typically is for folks.
Sure. I thought of a couple clients in particular, and again, whether you're a business owner or not, that's not the point. I think of these clients, they had worked hard, saved hard, as almost all clients we've worked with, very conservative, and they're just not getting direction. And so by learning strategies, I'll give you one example that actually creates a 10 times deduction, right? So in other words, using the least amount of capital to free up the greatest amount of tax savings. And ironically, they had approximately $600,000 kind of still stuck in their IRAs. And they looked at it and said, well, you know, the direction we got was, you know, maybe do systematic Roth conversion where you kind of swallow the tax a little bit at a time. And that's far better than just going out and doing it in one fell swoop.
Right.
In their particular case, we used the code to their advantage to be able to create this deduction. So they used $100,000, which created a $1 million deduction.
Wow.
Now, under the current tax law, you can use 60% of that in the first year. So that $600,000 was able to actually use that deduction to completely offset the conversion tax exposure on that $600,000 by just moving it basically from IRA to Roth IRA, but using the code to absorb the taxes, not their own capital to pay for the taxes. So basically using the tax code to get themselves untaxed.
Wow. Wow. And I'm sure that were they just blown away when you showed this to them?
Blown away. They've referred their daughter, their son. And the great part about that program, and there's several programs not exactly like that, but that can, you know, in the right fit for a client, you know, be a fit, are other things like a lot of viewers, I'm sure, are familiar with how they've used real estate to that advantage, right? And with the tax now trying to shove the capital gain tax to 44.6%, or the fact that inflation is making everything more expensive and it's costing us more to take out of these accounts to net what we need, right, to spend because it costs a lot more. They just want to get the tax man out of the way. And when we get the tax man out of the way, that's got to be the first step.
For sure. Well, I know we have less than a minute. This time has flown by, but what are some parting words of encouragement you would share to our viewers today?
You know, I would say as we talked, you know, the two tax systems in this country, one for the informed and one for the uninformed. And, you know, just getting informed, right? Taking the time to discover and uncover your hidden wealth, especially in the area of taxation. This is not a time, right? The Tax Cut and Jobs Act is going to sunset. It's going to sunset here in a number of months. The time to sit on the sidelines is not now. So take advantage of where the deduction is going to get cut in half, the tax rate percentages are going to shove up, and what you can do to just get yourself out of the tax system. It is possible. Don't let somebody tell you at the big box store brokerages, well, go see the tax person, and the tax person sends you back to the financial person. Take the time to learn how to do that.
Wonderful. Chuck, thank you so much. To our viewers at home, again, that number to call, 844-837-3652. Thanks so much for joining us. We look forward to being back with you next time here at Hidden Wealth TV.